Going live. We are live. Okay, so now that we're live, people are gonna start coming in, and let's make sure. Let's see. We can look down on here, so you can see right here where people coming in on here.
Okay. Yeah.
So when they come in, I can see them come in. But when you come in over here, you basically allowed to see everything at that point.
So do I share it to?
So you can share to your page. That right there.
Here. So do I share it to?
Share it on your page, right? That right there. So show them.
So.
So now you go to your page, you see it, and then you can tell people to tune in on it. There you go. And you can go edit and say, tune in, so that anybody on your page you want to see. Hi, you guys. I see there's people on here. We're getting started. We had some Wi-Fi issues, so I changed it to 245 and updated the link so that people coming in, they'll know that we changed it from 230 to 245. And this allows for us to be able to get set up because we had some issues with Wi-Fi. Anyway, thank you guys. So today we're going to be talking about some options available for you to get your new home, or you're trying to get a new resale, you want to sell your home, looking at possible loan choices. And I have someone here. He's going to introduce himself and let him speak and tell you all about what he does and who he is, and allow for you to be able to decide if you want to work with him in the future. I've closed about 3 transactions with him thus far, and what I really liked was the quality customer service that I received and the feedback as far as communication and letting me know what's going on throughout the transaction. And that's very important when you are doing business, is getting feedback and someone's communicating with your agent, so we know that we're all on the same page when it comes down to what you're trying to accomplish. And everybody's trying to accomplish the same goal, and that's to get you to the closing table. So go ahead, introduce yourself.
So I'm Vincent Powell, loan officer, Nationwide Mortgage Bankers, based out of Jacksonville, Florida. But as you know, I'm all over right now. I'm in Montgomery, Alabama, with Tisha Perry. So.
Okay. And so with you being based out of Florida, how does that impact when people want to use you for their mortgage process? What kind of programs you guys are offering nationwide? Because I know that I've sent you investors. He's working with some of my investors and my regular home buyers. We've had smooth transactions and so far.
Actually, by me being based in Florida, it has pretty much no bearing on it. We have products that we can offer nationwide, from commercial products, commercial loans for investors, fix and flip products. If you're trying to finance a business and do things like that, we have products that you can take advantage of. Even on the residential side, if you are, a first-time home buyer, we have down payment assistance options for those qualified buyers. If you are not a first-time home buyer and you're looking for options that have low down payment options, we have products as well all over the country. So I just encourage people to, contact us. Let's see what your situation is so that we can determine the best product for you.
So when it comes down to the down payment programs, or even the amount they have to bring if they don't qualify, what typically is the required score? Because a lot of people are being told all this information about the 580 FHA requirements, and they don't understand that there's overlayers that the lenders have when it comes down to qualifying for a mortgage loan. It's not one size fits all. Everybody don't qualify for the same exact thing. So how does that impact with being qualified? What is the score requirement? And even if the score low, what do you think when it comes down to that, it's still going to have to be met to even qualify for a transaction to be the close?
Okay, so our minimum credit score is 580. And like you said, I know you hear that a lot, but it could be deceiving. So everyone that comes through the door with the 580 is not going to we're not going to be able to do that transaction.
And what are some things that can cause a person with a 580 score still not qualified, even if they have the income?
Recent late payments on accounts, late payments in the past year on accounts, things like that, derogatory credit, collections and charge-offs, things like that, repos in the past 12 months or 24 months, actually. So that person with a 580 is going to be someone that has pretty much clean credit in the past 2 years. Someone with at least 3 to 6 months reserves. What that means is they have 3 months of whatever their mortgage payment is off to the side that they don't have to use. That's just reserves, 3 to 6 months of that. So that's, probably the person that's going to be able to get approved. So when people ask me, like, what's an ideal credit score? I'll say an ideal credit score is around 620 to 640. I see, a lot of people are able to get approved in that bracket, 620 to 640.
Right. So, like I always tell everybody, I'm not a loan officer, but everybody know I know about finances because I have a credit consulting company. Now we do credit repair, we deal with all kind of stuff, and we try to get people set up for success so that you don't have somebody pulling your credit, wasting your time just to tell you you don't qualify.
Right.
If you have a 580 score, you want to get your score higher, basically,
right.
To even get the better rate. To also, if you don't have any money, you're not going to be able to buy a home with a 580. Period. The people who are buying a home at a 580 obviously have money,
right,
and may have little to no credit. Meaning they don't have a lot of stuff on their credit. They just have slow credit.
Right.
Slow credit is just the same as bad credit because there's not enough scoring to be able to do anything with. But at the same time, it's better to have a situation where you have a better, higher score. Period. We're doing business. So you don't want to go in with the bare minimum. So if you know this year your score is in the 5s, you don't wait the next year to start working on it. You don't wait the next year to decide, oh, you know what? Now I want to get help with my credit. Or now I want a professional to look at it. Because I can guarantee you, if you go to most loan officers, they're going to look at it and tell you, we can't do that. You ain't going to hear nothing from them.
Right.
So I don't even send my customers to a loan officer until I know they are ready. So I know that we can actually do some things. Doesn't make sense. Make it make sense. If you're serious about doing something, prepare in advance. If now is not your time, who said your time will be next year? So now is the time to prepare by knowing where you stand today. Your income plays a role, your credit will play a role, all those things. So back to what you were saying when it comes down to qualifications.
Just to piggyback on something with the credit, just like your children, if they come on with a C, you want them to do, you always want them to do better. They don't want to shoot for the minimum passing score. So, in addition to that, another thing with, with the credit, they look at the debt to income ratio. So that's the amount of debt that you have divided by your income.
So what is debt to income? Explain that a little bit.
So all that is all of your debt that's on the credit report, everything that reports to the credit report, plus the payment on a new mortgage. That's included in the debt to income ratio, the total debt ratio, and you divide that by your income. And lenders use that to determine if you have the ability to repay the mortgage. So that's all it is. If it's over a certain amount, they figure that you cannot, you don't have the capacity to repay the mortgage. If it's under a certain amount, okay, you're a lower risk. So that's what lenders do. They're just assessing the risk.
So I noticed also when a person is trying to qualify for a down payment program, they may not qualify even if they have the scores and the income because of the debt to income ratio. Oftentimes people think that they can qualify for down payment program because they are a new first time home buyer. But I have to explain to people, first time home buyer does not mean down payment assistance because everybody don't qualify for down payment assistance. And what is typical the requirements for someone to qualify for a down payment assistance?
Typically, they're going to look at a 640 credit score. They're going to want the debt to income ratio to be 45% or less. And these programs are set up for low to moderate income households. So they're going to have an income limit typically. Depending on the county that you're in, they're going to have an income limit. So.
And I say this because I do have customers that I'm currently working with, and I was excited because they had the scores, and I didn't think they had made that much money, but because the person only made about $60K, but since she don't have any dependents, she didn't qualify for the down payment program that I thought she was going to qualify for. So she's going to have to come up with her down payment. But I have, as a broker, what my goal is to try to see if we can negotiate on a property that may allow for her to get some closing costs paid. But I will tell you that nowadays, just because the market is where it's at with the higher rates, sellers are not all still paying the closing costs. Right. Unfortunately, especially on a property that get multiple offers. If someone get multiple offers, they can choose not to pay anything because keeping it real, if you're selling a home and you have multiple people sending you offers, who are you going to go with? The person that asked for least.
Well, tell me, you do some selling side, so you're the listing agent and you're advising your seller.
Mm-hmm.
You got 5, 6 offers. What are you telling him? What is he looking at?
Well, we're going to look for the cleanest offer. I mean, at the end of the day, I mean, you know what I'm saying? I do both selling and buying. So I am a listing agent and a buyer's agent, but I do more buyers because of the program that I offer. And I fall in the category as a buyer's agent on most cases. So most of my transactions come from buyers, but I do listings and I have had several listings in the last year, and every last one of them don't really want to pay closing costs. So the ones that had multiple offers or was in an area that had high demand, they didn't pay any closing costs.
Okay.
The ones that really didn't have that many offers and it was already kind of tight with getting a buyer, we pay closing costs.
Okay.
Because of the circumstances, especially if you're in a rural area, you don't really got that much to work with. You ain't getting tons of offers. So you got somebody that's willing to buy and you're in a rural or it's a place that people ain't really moving to. Common sense would be you want to go ahead and negotiate terms so everybody can come out happy and get things sold.
Right.
Otherwise, you're probably gonna still be in the market for 6 months to a year, but you thinking you ain't finna pay that because ain't nobody interested in that area. So you want to sell the home. You do things based on facts. You list the home at a fair market value, and you can leave room for negotiation. So if it is a high demand, you might get an offer to give you a little bit more room. They can include the closing costs in the loan, meaning that if your house is listed at 200. And your house appraised for 220 or 210, you may have about $5,000 in there that you can allow for a buyer to include their closing costs. And that way you're not coming off the pocket because your bottom line will be still paid.
Right.
So it's ways to work out the transaction, but if the home is listed too high, there's no room to negotiate. Oftentimes we find people want you to do a appraisal gap clause. Appraisal gap clause, a lot of times people really don't want to do that because they're saying that in the event the home does not appraise, that you agree to pay for that difference. Most people don't have that. Most people don't have the money to pay more than what the house is worth. So you have to be careful with offering more.
And why would you want to pay more? I mean, if I'm a buyer and the house is appraising for 220, but the sales price is 240, I'm going to want to pay I don't know if I would want to pay 240.
Well, people have been doing it. I promise you, I didn't understand what was up because me personally, I wouldn't be giving nobody $30,000. I ain't giving nobody extra money for nothing, first off, but definitely not no 30 or 40 grand. In the last 3 years, right before COVID hit, I mean, when the rates were very low and everybody thinking they're going to get a deal, but they were paying higher for the house than they would pay now. So now people are getting better, fair price homes. That's not overly priced compared to what you were paying the last 2 years, where you had a lower rate, but you was paying more for the house.
Right.
I've seen several cases where in Georgia, because I'm a broker for Georgia and Alabama, people were having multiple offers and paying over the asking price. And some of my agents that I was working with, they were telling me they was getting 30 or 40 grand higher. On the high end property, we talking about homes that were going for like 400 to 500 to 350, 250. They wouldn't have paid 30,000 more because they want to get in that neighborhood. It's crazy because you got people from up north got money coming down, but the average person don't have an extra 30 grand to be coughing up. So I was like, where are these people getting this money from? Because I'm gonna tell you now, where are they getting this money from? Even here, last year, there was a few companies I was doing business with. And every time I sent an offer to them, they got multiple offers and cash buyers. And we're talking about for $250,000 homes. I'm like, who has $250 cash? Well, here's the thing. There are some companies out there that'll buy your home cash for you. They do have companies that'll buy your home for you, and so that you can go ahead and close the sale and then buy it back from them. But there's some risk there. So before doing anything like that, you need to understand the risk and all these things that's involved there, because obviously you're going to pay some money to do that. It's not free.
Right. I'm sure they're charging fees.
Yeah, it's gonna be fees for somebody to buy the house for you and you pay it back. That would be no benefit for me to do that, because even I was gonna do that for somebody. I was gonna buy cash and then I was gonna have them pay me back when they got the loan. Then of course, if I resell the home, I'm gonna increase the price. I'm not gonna sell the home for you. That's another thing. Yes, if I bought the house cash, you're not gonna
sell it for $250 that you bought.
No, if I bought the house cash, because I feel like I can do that, and I still make a mission because whatever. But if I bought it cash and I turned around and sold it to you because I bought the home for you, I'm going to increase the price a little to recover some of the monies and also make a profit. It wouldn't have benefited me to do
Just
that.
buy it
So
and-
the companies, the bigger companies who were
Yeah.
able to do that on a wider scale, I ain't balling like that. Well, I'm buying
Not yet.
several houses cash, $1 million of deals cash. No, I am not balling like that. And if I was, I wouldn't tell anybody. But the bottom line, I wouldn't let nobody know I'm balling like that. But I'm not. But at the same time, when you're doing that, obviously it's not just one person. Like these companies, people are coming together as teams.
Right.
One reason why people are able to do this and leverage the finances is because it's just not one person.
Mhm.
People go in business with teams, with different banks and different people with money. They put their money together to be able to do all these things,
Right.
and they're taking over. Even companies now have it where they're doing listings for a little to nothing. I haven't had great experience with the communication when those companies just list your property for you and then they don't do the customer service side. It's horrible. And the seller is obviously going to have to handle everything. It gets crazy with the communication between the seller, that third party who said, well, we're just a listing company. We don't have any control over anything. The communication and response time is delayed. You send the offers in the email, they're not responding. Also, when it's time to negotiate and have a real conversation about some things, they're not responding. I don't like that. Now, I understand everybody want to cut back on some fees, but you get what you get. You have somebody you're working with who's not professional, who just want to list your house and charge you a small little fee to get it in the market, and you're going to be responsible for everything. You may not get the best bang for your buck.
Right.
And the transaction may go crazy because, first of all, if you're not working with another realtor who knows what they're doing, they're letting people show houses who not even gotten pre-qualified and already gotten their documents in. Going out and showing houses and you're not already pre-qualified, you run into a huge red flag of not even closing that transaction because you haven't done your due diligence. Turn all your required documents in to avoid not closing on that loan. Complete the application, get on your whatever. Matter of fact, we're going to go over the things that you're going to need to have when it's time to get approved for a mortgage loan. Have me that water right there for a second. Appreciate it. Gotta have my water. So tell them when it comes down to applying for a mortgage, what are the documents you're going to need?
So the simple documentation that you're going to need is photo identification card. We need to know who you are. You're going to need, if you're a salaried employee, you're going to need pay stubs covering 30 days. They want to verify 2 years of employment history, so they use W-2s for the past 2 years. That's your income, and of course, we're going to run the credit. Also, assets. They need to know that you have sufficient funds to close the transaction. So they're going to look at 2 months bank statement. They're going to look at your retirement account because a lot of people can use retirement funds to purchase a home. A lot of retirement plans are allowing people to use retirement funds to purchase a home. So you could provide the retirement account statement. And I mean, that's pretty much it to start with. I mean, we got your income, we got your assets, and we got your credit. Those are the 3 things that you need to purchase a home.
And one thing about using your retirement income, I'm thinking you have some tax benefit where you're not tax penalized because you're reinvesting into a property.
Yeah, a lot of plans do that. They don't hit you, I mean, for lack of a better word, hit you with a lot of fees and taxes if you're purchasing a home. I would just recommend going to read the fine print on the withdrawal requirements of that program. But yeah, I mean, the documentation is simple. A lot of people have all that information accessible on their phones. Pay stubs, they can log into their system and grab the pay stubs and W-2s and stuff like that. So it's a lot. It's not a lot of documentation that's needed to get pre-approved. So that's pretty much it. If you're self-employed, they're going to look at the most recent 2 years of the self-employment history. So the most recent 2 years of tax returns. If you're not a Schedule C person, then they want your business and personal tax returns, so they can kind of calculate the income, make sure that, a lot of times self-employed people write everything off. So they just make sure that it's not, all the income is not written off.
Yeah, so that's one thing I run into with a lot of people, even some family members that I would like to help buy a home. Everybody wants to try to get money back. It's not about getting money back when you try to do some things. When you're making money, you need to show the money.
Right.
At least for 2 years. At least do right for 2 years so that you can get your house. Because if you're making money, you're paying rent, and especially once you get over 30, that money to get really tight. You're spending $1,200 and more for rent. When I was renting back in the day, I would not pay those $1,200. Like, I'm glad I don't have to rent, because me paying $1,200 for rent, I'd be mad. You got to put me in a high-rise sky apartment somewhere downtown. You know that costs $2,000. So what I'm saying is the cost of rent has gone up since I actually had to rent, and I can imagine having to pay $1,200, $2,000 just to rent somewhere when I know you can own a home. I own a brand new home 20 years ago paying $1,200. 150, and back during that time the interest rate was higher. So at 150K, I was paying $1,195 for a mortgage. Recently, with people who had the lower rate, when the rate dropped on 150K, the mortgage was probably around about $1,000, 900 and some dollars, because of the rate was so low.
Right.
So people were used to saying or thinking that 3% was a normal. When I was buying houses 20 years ago, we wasn't getting no 3%. That wasn't any. We was buying at 6% or 7%. And that was considered to be a good rate during that time, because my scores has always been good. And so when I say this, it's like, the thing is, you're going to be paying rent and you're paying 100% interest.
Right.
Okay. And then you own nothing and you're getting older. So at some point, you know, ain't nobody getting young. You're paying rent. You're not solidifying your cost of living for housing expense. When you decide to buy or own something, even though you got to pay taxes and you know you will never truly own something outright and not have to pay any fees, the difference is it's yours though. You can use it and have equity. You can use it to will it, deed it, whatever you want to do, sell it down the line when you get retirement age and buy something else. The bottom line, as long as you're renting, you have no equity, you're paying 100% interest. You have nothing to show for it but the fact that you have a place to live. We all may have to rent at some point. There's nothing wrong with renting, of course. You need a place to live. Duh. We're talking about people once you get up to a certain age and you know that you're trying to solidify your cost of expense of living. Cost of living is going up. It's never going to go backwards. You know, so if you're making X amount of dollars and you know your income is not going to increase dramatically in the next 5 or 10 years, but the rent is still going up, the cost of living is still going up, you're going to be behind. You know, so I look at it this way: when you get something that belongs to you, you solidify your housing expense so you can have a stable place to live as you age.
Right.
Because if you don't, you're going to be paying rent and you have nothing. And then when it's time, when everybody keeps talking about this high rent, I remember like last year, people rent was going up $300-$400, $500. I said, is that legal? Like, I'm like, my gosh. If I was living somewhere renting and my rent was like $900 and now I got to pay $1,400 or $1,200, I'm like, who does that? Most people don't have an extra $400 or $500 available.
Right.
The average person don't.
Right.
Don't have an extra not for the place. If you rent it $900, you definitely ain't trying to pay $1,200 for that spot. You know what I mean? But if you have nowhere else to go, it's like you're gonna do what you have to do to survive. So by buying something, it sets you up for success when you have your own. And when it comes down to refinancing a home, this is the thing I want to talk to you about, because obviously we, as realtors, we always tell people, yes, you may be able to refinance, but we all know if you don't have the income and credit, you're not going to refinance. Right. So based on your level of expertise and what you're doing, what is the things that people need to be aware of when it comes down to refinancing?
Well, when it comes down to refinancing, I had a lot of people that maybe purchased a couple of years ago, and then they come back and maybe they need to get some cash out and stuff like that. For some reason, when we approved them, they had acceptable credit, and then next thing you know, when they come back to refinance a couple years later, they don't have the credit. A lot of people, when they buy the house, they forget about keeping their credit up. You know, I've seen it time and time again. It's like they get the credit to get, where it needs to be in order to purchase the house, and then once they purchase the house, they kind of forget about it. So I would say, the same energy that you put into your credit when you were purchasing your house, it needs to be the same energy that you maintain forever. I mean, because you never know when you're going to need to refinance. You're going to have to do a cash out, and then now your credit is shot. Because what typically happens is they buy a house, then they go buy an automobile, then they get all these cars and stuff, buying furniture and things like that. And then, when the usage is high on those credit cards, the credit score goes down. So that's what I experienced. Then they come back to me and they were like, okay, I'm ready to refinance. And they can't refinance.
Another thing I will say, as a consultant, a credit consultant, oftentimes people only look at their credit scores. They really don't pay attention to the reports of what's really happening with their finances. We need to do better with that. Okay. Credit scores are very important, but if you don't know what's on your credit, it ain't gonna do you no good. You ain't gonna know how to control your credit score,
Right.
how to get it up higher, what is impacting my scoring,
Right.
what exactly I'm gonna need to do to improve. You need to look at the reports. And then you're paying $20-some a month for a subscription just to have it. I ain't paying nobody no extra money for nothing if I ain't taking a look at it. So looking at scores is good, but those scores, you know, ain't gonna get you nowhere if you don't know what's going on with your report. You don't have to look at your credit report every month, but if you're looking at it every 90 days, every 6 months, keep track of what's happening with your reports. And obviously, if you're using credit cards all the time and you're not paying them off, you're not winning. One person I know that's like, because you know, when we've been in the credit industry, and I was talking to one of my fellow realtors, and she was like, well, you know, I use my credit card for everything, and that's how you got all these points. I said, it sounds great, but if you're not paying the card off, then those points mean nothing because you don't pay. That's your money. That's the money, the interest you don't pay. So I know that for a fact. I'm real funny about that because I'm like, I don't like paying no late fee, and I ain't really trying to pay no high interest. So if I find myself forgetting to pay, because I got everything on auto pay now, I don't keep track. I mean, I just pay everything automatically out of my bank accounts, and I don't have to worry about paying my bills. I'm family at that point. Like I'm so grateful that I don't have to worry about that. And that's where it's the ultimate goal for anyone who's a working party. You're working hard. You want to be able to have your stuff set up on auto pay so that your bills are just paid. But the trick about that though, anything that's going on with your bank account, you want to keep track of what's happening, because if something happened with your bank account, the auto pay stops, or there's an issue with the payment not going through. If you don't keep track and you don't follow up, it can hurt your credit report if you don't do it within 30 days.
Right.
Okay. If you don't, you just ignore it, all something happened with my bank, but you know you had auto pay. If you have auto pay, check with the companies, make sure your payment is cleared. Because if not, now that payment is not going to report to the credit bureau, and you're going to have a late on your report. How do you go months with that? I've dealt with this. You know, how do you go months without knowing what's going on, that a bill is not being paid? And then all of a sudden, like, well, I didn't know it was coming out of my account. You're supposed to know. I don't care if it's $30, if it's $10. If something's not coming out your account, and if it's something that's reported to your credit, those things you definitely want to keep track of. If it's a gym membership, oh well, you know, you can follow up with them at the gym, because they ain't gonna let you keep on using the membership, because at some point they're gonna realize your membership is not paid for, and they're gonna call you. But a credit card company usually will call, but oftentimes you'll get a letter in the mail or email. Right. Everybody emailing you now. If you're not checking your email, you don't check your mail, you don't not paying attention, you don't know these people are trying to notify you. They're not going to let you go 30 days late without notifying you some way that the payment was not received. So we have to be responsible to check these things, because if you're not, that's what's happening with people I know. Credit is being hit with late payments, and when it's hit with a late payment, it hurts your credit scores. It can drop anywhere from 50 to 70 points to 75 to 100 points. That's a big deal. If you're in the 700s, all of a sudden, bam, something hit your credit. Now you're in the 5s. I mean, or now you're in the low 6s. Listen, man, no, I'm not interested. So, and we all may be too busy, but you definitely want to keep track of that, because I see it quite often where people want it to go downhill. And we're talking about people with jobs, with income. You know, people go down here, they want to go balling at the beach, but you ain't paying your bills. Like, come on now. You know, and I ain't knocking nobody for wanting to enjoy life. You have to take time for family and enjoy life. But, you know, bills need to be paid. If you're trying to accomplish, you ain't accomplished your goal yet. Make your goal priority is for your home ownership. Get that taken care of. Have money in the bank where you can do some stuff. Because if you don't have that, then it's like, what are we doing here?
Absolutely.
So I get a lot of emails from you about the programs you're offering when it comes down to commercial. You're doing commercial and you're doing investment loans. So tell me a little bit about that side of your business as well.
So the commercial side of the business is something that we're really excited about, because we're able to offer loans for people who need commercial loans. If they're doing any type of property that's that doesn't fit into the conforming properties type, such as 1 to 4 unit properties. If they're doing apartment buildings 6+ units, then that falls under the commercial. If they're trying to finance a daycare or something, that falls under commercial. If they're doing fix and flips in their business name, that falls under commercial. And we're able to offer financing solutions for these clients. So we're really excited about that. And we have a dedicated department that's dedicated just to that. And so we work really well with that department.
Now, when it comes down to commercial and buying your first commercial property, oftentimes, I was in the middle there because I thought I had 800 and some scores and I thought I was going to get a deal. No, the interest rate, they don't care. I mean, you got to have the scores on, but that don't mean you're going to get a deal because your scores are great. Like, I was really disappointed. I'm thinking I'm going to have this great rate because, I got the great credit and all that. No, when you're doing a commercial, that's a money-making thing.
Mm-hmm.
So when you're making money and buying an investment, it's totally different. Just like if you buy an investment property and it's not a primary residence, you're not going to have the same rate as someone who's buying it as a primary residence.
Right.
Typically, there are programs that allow for you to buy even no loan docs. I mean, not no loan, no proof of income.
Right.
But you got to have the scores.
Right. You got to have the scores.
And you got to have money in the bank. You're not going to do no proof of income when they ain't got no money in the bank and your scores are bad. So explain about the no proof of income docs.
Yeah, we have loans for self-employed people. A lot of times they use products like bank statement loans.
Bank statement loans.
So if a lot of people, like we were talking about earlier, they may write off their income and stuff like that. So they can use their bank statements as proof of income.
Mm-hmm.
Okay, that's one product. Another product is we have a 1099 only loan. So they don't file their taxes or they don't file all the income on the taxes. They can use the 1099 form and qualify for the loan. Another one is DSCR, meaning for investors.
So before you go to that, the 1099 loan, how does that work? Like somebody obviously work for a company as a contractor. They give you a 1099 and you haven't been filing taxes, but you got money in the bank. So all you provide is a 1099, and what's the score requirement typically for that type of loan?
High. No, but I don't know the typically somewhere around a 660 or a 680.
Okay. And then what kind of money you got to put down? 20 or 30%?
Yeah, typically, and it goes on a scale. If the lower the credit score, the more that you have to put down.
Okay.
The higher the credit score, but I think it's typically around 20% down.
So that's normal anyway for an investment. So if you got 20%, which you probably can do that if you got the money saved, because you saved instead of having to pay taxes like most of us. They keep taking my money. But anyway, so you're saving money because you ain't paying your taxes. But now, when it comes down to the rates, is it a large amount of difference or not that much?
It's usually what I've seen is maybe a point or two higher,
but not that much.
Not that much.
Because you're putting money into it.
Depending on the credit score, again, it goes back to that credit score. The people with the higher credit score is going to get a lower interest rate. Lower credit scores get a higher interest rate, and that's just how it is. Because the lower your credit score, the more of a risk that that they look at it.
Right.
So, yeah, I mean, but there are solutions. There are loans for people who don't need to verify income.
Right. So if you're making six figures and you haven't been filing taxes and you want to buy a property, you can't be making money, don't file taxes, and have bad credit.
Right.
I mean, at some point, if you're making that kind of money, you should already be working on your credit anyway. It should be actually in a better credit situation if you're not blowing the money doing nonsense.
Exactly.
So the goal is if you make that money, you want to make it work for you. And if you haven't filed taxes, get them done, or you can go ahead and do things in a position where you can save the money so you don't have to worry about being verified that way. But at the same time, there's a lot of things involved with that. So you finna mention something else outside of that?
DSCR loan. That's basically
DSCR loan. What is a DSCR loan?
Debt service loan.
What does that stand for? Like, it allows for you to do what?
It allows for you to use the income on the house to qualify.
The income on the house, or if it's rented, like if it's an investment.
Yeah, if it's an investment. So basically, if it meets a certain ratio, which is it covers the mortgage payment. Typically, it covers the mortgage payment. Then they'll say it has a debt service ratio that's acceptable. And then you don't have to that is your verification. I mean, it's a home that is you're an investor, and it's a home that you're going to be renting out. So the probability of it renting for this amount based on the comparable rent schedule from the appraisal is, that's what they look at. So
is that considered like a commercial as well?
No, that's going to be that's that can be done as a regular loan. It's not a conforming loan. It's a what they call non-QM, but it's not commercial. But they do have similar commercial products like that as well. So.
Okay, right. So there's something to think about. That there are so many opportunities out there, and not having knowledge, you fear badly because you don't know what's out there. So don't assume that just because the rates are up that, oh, it's not for me, I'm not going to be able to do anything. You will keep renting because the rates ain't going to go back down to 3% no time soon.
Nope.
I mean, it's going to stick.
That.
Yeah, it's not going to go. You'll be waiting for years. Because I mean, matter of fact, it's been about, I don't recall. Okay, when it started at 3%, I think that must have been like 2017. When did rates go down? When did it start doing 3%?
I noticed that they went down like that, and it was like 2020.
2020.
Mm-hmm.
And
when
then
the pandemic around that time.
Okay, 2020. Oh, so that was recently. So that wasn't even at 3% in 2017. I had somebody say about.
I mean, they may have, but generally,
some builders have their own program. So new home build. I had a few people that had new homes, and they bought, and they were able to get a deal because of the new home construction. And sometimes the new home constructions buy your rate down for you. D.R. Horton has programs, stuff like that. If you get approved to their preferred lender, and they have in-house lending as well. So sometimes they have a negotiation between those banks. Of course, all banks have requirements. If you don't meet the requirements, you're going to have to get approved somewhere. But there's always different incentives that the new home build, new construction. And somebody gonna make a comment on one of my posts about not buying new construction because of you're like buying a lemon. Buying a house is not like buying a car. I mean, these homes have to be inspected with codes and all that. So no, I mean, that's like buying a car. I remember when I had bought a Tahoe truck years ago. My Tahoe truck had so many issues. I had transmission problems. I kept on paying to get it fixed. I don't even know why. I would never do that again. I would sell that bad boy now if I had that problem. But at that time, I was so proud that I got my little Tahoe. And I tell you, I had so many issues with that transmission, and I spent maybe like $6,000 because the first time it happened, $2,500. Then the next time it happened, another $15,000, and all that. So when I say this to say that a car is a car, but someone else had the same vehicle. They didn't have none of the same problems. They didn't have none of the same problems I had with my Tahoe truck. And I kept that truck for years. I was so proud of that. You know what I'm saying? Back during that time, it was the thing, to have. And I was like, I would never do that again. But when you buy a home, it's just like, you don't know what when you buy a home, just somebody else had a problem, that means you're going to have a problem. And I said, that's why I was giving an example about my Tahoe truck. I bought a truck. I had so many problems with that vehicle. And I kept it for years. And somebody else had that same exact year, same exact model, and had no problems. They had that truck for the same amount of time frame. So that tells you there that it's not a one size fits all. Just like because if you buy a new home now, 10 years from now, the house is going to be trash. Don't listen to people. I mean, I've sold enough homes in the last 20 years to know they don't apply to all scenarios. Right. Now, there have been cases, even before everything got hot, that somebody might buy a home and had problems with the home. But not everybody in the whole subdivision had the same problem. It could be just something that, unfortunately, that's why you got to get an inspection. Even with an inspection, the inspector's only going to see so much. Right. But get insurance and make sure things in place. Just like if you buy a used vehicle, you're buying these used vehicles, get some type of insurance or some type of warranty, extended warranty, because if the transmission go out or the engine go out, you still owe the money. If you send it back, it's a repo. The person you buy it from is no longer responsible for that car. And oftentimes I find that people get repos, and the main reason why they have a repo is the car needs repairs and they don't want to repair it. They don't want to fix the car. So you're thinking, well, I don't want to fix the car. I don't want to have the money to spend that. But then now you got a repo. Okay, so you can go get a loan or have some little savings and go get it fixed. Now you're going to let the whole $20,000 hit your credit, and it's going to set you back even more. Because typically, most banks don't want you to have any recent repossession 2 to 3 years. Right. And even if you do qualify with the repossession on your credit, they're still going to count a percentage against your credit as far as your debt to income ratio. It's still count. It's not just counted out. Now, one last thing we're going to discuss, and we're going to wrap everything up. I really appreciate those who have tuned in. And I know that video will post, so you guys will be able to tune in later and see. And I'm sure people will comment later on. One last question. When it comes down to student loans, what is the situation with that now? So
typically, worst case scenario, what they'll do on FHA loans is the underwriter, they'll include a payment of 0.5% of the balance. So if you have $100,000 student loan, they'll include $500 as your payment. That's worst case scenario. Now, if you have an income driven repayment plan and you have documentation of that, whatever that payment is, then they can use that if it's for 12 months past your closing.
Okay.
Now, on conventional loans, on some conventional loans, Fannie Mae, they use 1% of the balance. So if you have $100,000 student loan, they'll use $1,000. Freddie Mac will use that 0.5%, so it'll be $500 unless you can document a payment. If you can document a payment, it could be $10. Then they'll use that if it's on a, if it's on their letterhead and they say this is your income-driven repayment plan, it's $10 per month. Then
most of everybody's on zero, so they count a 0.5%, and these people are only not making enough money to really do anything.
Right.
And that's the thing about going to college. We always was told to get a degree, but if you're not getting a degree to give you the job that's going to be to pay some bills and do some things in life and get your home, then you're upside down. It's like those student loans can prevent you from even buying a home.
Right.
You can get the car. It's the first thing people want to do is when they graduate is get a car. And they don't get no regular car. They want to get the top of the line, baby. You paying $800 to $1,000 for a car, you're only making $50,000 a year.
Right. And
then now when you're ready to buy your house, that car loan is affecting that as well as the student loan debt. Everything is involved.
Right.
Everything's it's not just every debt that you have on your credit, good or bad, is counted when it comes down to purchasing a home. So you have to understand these things.
So we had a client, a couple of clients in the past month that were able to get those letters from their student loan servicer showing the income driven repayment plan, and it was a lot lower than the 0.5%.
That'd be great.
That they can include that into the debt to income ratios if they have that documentation.
Okay, well, that's good to know. So we've covered a lot of things today, and the video will be posted for anyone who want to go back and listen in and tune in and see what we had to say in the last 42 minutes. I'm glad it worked out. I'm glad we was able to go live. I missed doing my live, so this was a great opportunity for me to go live with another real estate person. He's a mortgage broker, and how will people contact you if they decide they want to reach out?
Oh, if you want to reach out to me and have a discussion about a mortgage, I can be reached at 904-534-7823.
And you can also send them a message on Facebook.
Absolutely.
So thank you guys for tuning in, and you guys have a great day. Bye-bye.